guest investment strategy, runs a fund rated 5 stars by Morningstar. Let's bring in Eli Horton. He's senior portfolio manager of the TCW Transform Systems ETF. Eli, it's so good to have you here. Welcome to Fast Money for the first time.
Great to be here.
So obviously we've seen a lot of world leaders meet with the president. It seems like there's some negotiations that might be happening. When we look at the markets in the last couple of days, you would see perhaps a benign reaction, but there's opportunity there that you see. Can you explain to us what you're looking at?
We think the opportunities are abundant, and we're actually looking for them in, I think, places that most investors aren't, and hopefully that's a good thing, be a little different and expect different outcomes. There's a couple, we'll call them mega themes, we're extremely interested in. One is the transformation of the global energy system. Two is the reindustrialization, the remanufacturing of the U.S. I heard the prior comments on Ukraine and the meetings of the White House. And I think that we're migrating from a fossil fuel system to something that's close to 100% renewables. And geopolitical tensions, global security, that is yet another reason why this is happening. Same thing for remanufacturing. So these are themes we're really excited about in today's market.
Can you give us some actionable plays there?
Yeah, absolutely. And the comments on nuclear a moment ago are very relevant. We're extremely interested in the theme of power scarcity and the need for grid investment. So to set the backdrop, in the U.S., electricity demand's basically been dead flat for 20 years. That is now completely flipped on its head. We believe that by 2050, electricity demand doubles. Why? A few reasons. One, reindustrialization, remanufacturing. Two, electrification of transportation and really our entire economy. Three, AI. And AI gets all the headlines, but it's only about a third of the electricity growth.
I was going to say, I was surprised you said AI third.
It's about a third of the growth. And even with that said, it's fascinating. We need to add something like 75 gigawatts of demand to the grid by 2030 for AI. 75 gigawatts is opaque. It means nothing. New York City has about 5.5 gigawatts of capacity. So what is that, 15 New York Cities worth for AI? So a lot.
That's a lot.
And think about the capital goods and the Capex to serve this.
Unless you worked there or covered it, nobody ever heard of Vistra Corp over the last decade or so. Became somewhat of a household name in our world over the last year and a half. It's gone from a $40 stock, I think it's north of 200 or right around there, $68 billion. Still reasonable valuation, and the story's obviously out there. Is this a name you can still own here?
I agree. We own Vistra. We've owned it for over 2 years. We really admire the company and their capital allocation decisions, and they have a very valuable portfolio of power generation. So they acquired a nuclear power generation business, Energy Harbor. That was incredibly value accretive. Nuclear power prices have more than doubled, as you've seen from some of the hyperscale deals like Amazon and Microsoft. They also have natural gas. And the fact remains, we cannot add enough wind and solar to the grid to solve for our electricity or power shortage. Can't do it. You need natural gas. Vistra has a very attractive nat gas fleet. We think the company's going to earn more than the street does. We also think the multiple is very reasonable, and it fits right in a bottleneck of businesses that are capitalizing on this theme. And to your point, it's not a household name. Most investors haven't heard of it. Most investors are unexposed to these types of businesses.
Eli, help me out with this. Torsten Slok of Apollo had a note out today. I thought it was really interesting. We all know that 70% of U.S. GDP is consumer spending, consumer demand. And he highlighted the fact that in the first half of this year, that capital expenditures related to AI data center build-out actually had the same contribution as consumer spending. And when you think about that, like these are some themes that you're focused on. At some point, there will be a slowdown in Capex spend for AI, and it might come at the same time that the consumer is having a difficult time and slow down. That changes a lot of dynamics in our economy. I'm just curious, like, how you think about that.
You have to watch it. And this is a great reason to not invest passively and to invest with an active investor who's deep in the weeds and doing bottom-up work. That's what we try to do. We have a portfolio of 20, 30 stocks. We try to be in the details and have a differentiated view. With that said, if you look prior to 2023, U.S. Capex to sales ratios were at 20-year lows. We have chronically underinvested in the industrial goods, the manufacturing footprint, the grid of this country. The average high-voltage transformer is 40 years old. So just as we went through chronic underinvestment, we're now on a collision course with structural Capex needs to grow our industrial base, to rebuild the grid. And so, yes, we're watching it, but we think that this Capex is very needed and very warranted.
before we let you go, some of the old economy stocks that you're interested in. Tell us about this theory and give us some names.
Well, look, we talked about Vistra.
Yep.
There's a variety of businesses. GE Vernova is another interesting one. So we've owned GE since the day it spun out of General Electric. It used to be called GE Power. No one cared about it because nat gas turbines no one wanted one. And in 2023, they produced about half the number of turbines as the prior decade average. Nat gas was left for dead. There's like 3 companies in the world who make these. And so we're able to find some of these old economy companies that have faced headwinds for really a couple of decades as manufacturing moved out of the U.S., that are now seeing those headwinds turned into tailwinds. That drives an acceleration in fundamentals against valuations that are attractive, and that's a nice backdrop for us, and it's a good complement to what's in the broad indices, which doesn't really look like old economy for the most part.